Hello everyone, my name is Emily and my teammates Zhiying, Xintian and Jovin will be presenting our analysis on the financial performance of Seng Group over the years by adopting financial ratios analysis. Seng Industri Berhad is a major cracker and biscuit producer in Malaysia, which was founded in 1958 and then was listed on Bursa Malaysia in November of the year of 2000. Seng Perusahaan Makanan Sdn Berhad, Seng Hunyung Brothers Sdn Berhad, and In Comics Food Industry Sdn Berhad are the three subsidiaries of Seng Group. And now, before we go into our analysis, what is financial ratios? Financial ratios are the tools to help a business manager and an investor in analyzing a company's financial statements with the measurement of profitability, liquidity, efficiency, long-term solvency, and shareholders' investment in order to enhance the business performance in the future.
Overall, Seng's financial ratio performance between 2019 and 2020 based on profitability has improved, as the group generated more revenue from its equity and assets, despite slight weakening in gross profit and net profit due to weak management in core sales. Seng's gross profit margin decreased by 6.06%, indicating fall in business ability to make gross profit from sales as cost of sales increases. Besides, Seng's net profit margin declined by 1.91%, implying reduction in firm's capability to earn net profit from sales, caused by increases in sales as there was launch of new products and establishment of online stores on Shopee in 2020. Moreover, Seng's return on equity rose by 9.39%, showing the firm utilized the shareholders' investment efficiently in generating more revenue due to change in net profit and capital structure. Additionally, Seng's asset turnover grew by 0.09 times, denoting an improvement on firm's capacity to profit from its assets, as Seng's replaced old machineries with automated equipment in 2020 to improve productivity and product quality. Due to expansion in production line, Seng's inventory increases, especially for raw materials, to fulfill market strong demand, generating more revenue and higher asset turnover. However, Seng's overall liquidity performance between 2019 and 2020 has declined, suggesting the group's ability to pay its debt obligations has deteriorated. Seng's current ratio declined by 6.25%, implying decrease in capability to meet short-term obligations because current assets declines as Seng's only conduct businesses with reputable and financially responsible stakeholders, leading to reduction in trade and other receivables. Despite current ratio drop, the firm still has sufficient financial resources to stay afloat and maintain in the short run. Furthermore, Seng's quick ratio dropped by 10.69%, indicating decrease in firm's capability to fulfill short-term obligations using its most financial cash, because current liabilities increases as customers obtain commercial rewards from Seng's if they achieve specified standard highlighted in their agreements, leading to increase in refund liabilities. Despite quick ratio drop, Seng still has adequate assets to pay off its present creditors quickly.
From 2019 to 2020, Seng's efficiency ratios have improved, which means it has been more efficient in utilizing its assets to generate income, despite there were only slight changes. First, its trade receivables collection period decreased by 7 days, which means it took a shorter period of time to collect payments from its customers for credit sales. This is because of the decrease in trade receivables. The reason is it settled its trade receivables from export sales through credit letters issued by reputable banks, and its credit risk also decreased. Additionally, its trade payables payment period decreased by 1 day, which means it took a shorter period of time to make payments to its creditors for credit purchases. This is because of the increase in both trade payables and cost of sales. Besides, its inventory turnover in days decreased by 0.15 days, and inventory turnover in times increased by 0.02 times, which means it replaced and sold its inventories at a higher rate. This is because of the increase in both average inventory and cost of sales. The reason is it gained benefit from the COVID-19 outbreak, because during the MCO period, customers store a lot of staple food products with long expiry dates. So it was able to replace and sell its inventories at higher rates while meeting consumer demand. From 2019 to 2020, Seng's overall long-term solvency ratios have improved, which means its financial and economic health has improved, despite a higher leverage ratio. First, its leverage ratio increased by 5.41%, which means it used more debt to run its business. This is because of the increase in total liabilities. The reason is it incurred more refund liabilities to provide trade incentives for its clients in exchange for meeting the performance requirements in the contracts. Furthermore, its interest cover increased by 477 times, which means it was more capable of paying interest on debts. This is because of the increase in profit before interest and tax. The reason is it continuously improved its product quality and expand market sales. So it gained more profit and has sufficient money to pay interest on debts. From 2019 to 2020, Seng's shareholders' investment ratios have improved, which means it was more capable of generating its assets through issuing equity shares despite a lower dividend yield. First, its dividend yield decreased by 5.25%, which means its dividend payout rate has decreased. However, this also indicates that it is a less risky yet consistently growing business. This is because of the increase in market price per share. The reason is it advertised its product on social media during the MCO period, and this increased the demand for its products. Furthermore, its earnings per share increased by 0.18 cents. This is because of the increase in net income. In 2019, its net income was lower because there was a Sino-US trade war which reduced its production as well as exports. In 2020, its net income increased because it participated in the online market and its advertising strategy increased demands for its product. Finally, its price-earning ratios increased by 7.49%. This is because of the increase in market price per share. The reason is it will be running a new cracker line to broaden its products. It also improved its brand image by expanding its shelf space presence.
And now, looking at the trends of both companies, Seng and Huatai, we can see that Seng has a downward movement trend of gross profit margin over the last 5 years, and it is due to the usage of high-cost raw materials in production. On the other hand, Huatai had a sharp decrease in 2018 due to the price-fluctuated raw materials in production, and it started to rise in 2019 and 2020 due to the higher demand in the market. And we can see, although Seng's gross profit margin is still higher than Huatai in 2020, but it seems like a first declining trend will be soon lower than Huatai in the future. And thus, if Seng does not lower its cost of sales to increase the gross profit margin will be continue falling in the future. Therefore, in terms of gross profit margin, we can see that Huatai is actually doing better than Seng in managing its cost of sales. Now, looking at the trends of the current ratio, Seng has a downward movement trend over the last 5 years, and this continuous decline was mostly due to the decrease in cash and bank balances, trade receivable, while also facing a difficulty in exposing the information in credit risk. On the other hand, Huatai was also having a declining trend every year, and the reason why it fell is because Huatai has maximized the exposure in credit risk, and most of their borrowings are actually based on the floating interest rates. As a result, we can see both company current ratio were actually declining every year, but Seng is still having a much higher current ratio than Huatai, which indicates Seng is still performing better in maximizing the current asset and minimizing short-term debt compared to its competitor, Huatai.
By looking at the trade receivables collection period trend, we can see that Seng had a stable movement of trend over the last 5 years, but recorded the lowest in 2020. According to Seng's annual report 2020, the reason is it settled its trade receivables from export sales through credit letters provided by reputable banks in nations where its customers are located. Whereas for Huatai, it has an upward movement trend and it increases significantly in 2019. And this is explained by its annual report 2019, where it states that they have a greater spending on promotions and advertisements to attract more customers and raise domestic sales. As we can see, Seng's trade receivables collection period is much lower than Huatai's. So we can conclude that Seng is more efficient in collecting payments from customers for credit sales. Next, looking at the leverage ratio trend, we can see that Seng's leverage ratio had an upward movement trend over the last 5 years and had a sharp increase in 2017. And this was explained by its annual report, where it says that the group's leveraged team building activities of the trading segment to introduce and launch its new product in November. For the following years, it was caused by its sales and distribution network to sell its agent products to boost its revenue. Whereas for Huatai, it also had an upward movement trend over the last 5 years and a slight decrease in 2017. The reason why Huatai's leverage ratio is higher than Seng's is because it utilized debt to run its business from 2016 to 2020, and a huge amount of that is explained by the company incurring high depreciation and amortization expenses, resulting in a debt load that's larger than it appears. As we can see, that both of their trend movement were moving upward. However, Huatai's leverage ratio is still much higher than Seng's, so we can conclude that Huatai is using more debt to expand the firm's asset base and generate returns for shareholders, and Seng has a lower and stable leverage to meet its financial obligations than Huatai. Lastly, looking at the earning per share, we can see that Seng trend movement was moving downward and slightly recovered in 2020. Seng hit the lowest EPS in 2019, and this can be explained by the Sino-US trade war, where it resulted in lower palm oil, crude oil, and natural gas production, as well as the exports. Whereas for Huatai, it had an unstable movement trend as it has a significant drop in 2018 and slowly recovered since then. The significant drop in 2018 was caused by investment in the group's affiliated company having been impaired and share of the related company's larger loss. In 2019, Huatai also experienced a negative EPS, and this can be explained by Huatai incur a higher expenses on advertising and promoting activities in their domestic and international markets. As we can see, Seng has a much higher and more stable EPS than Huatai, so we can conclude that Seng is a more profitable company than Huatai.
Overall, Seng is a better investment choice as it is a growing business with rising financial performance over the last 5 years. In comparison with Huatai, Seng's financial ratio reflects a better performance despite decline in gross profit margin. Hence, rational investors are advised to invest in Seng as it is a more stable and less risky company. Seng also has a great potential to continue to outperform its competitors in the same industry in the future.